And he said, if you think those are fun, if you really enjoy that type of stimulation, then he said, I'll show you a game that is the most exciting, the most challenging.
Paul Tudor Jones has made a name for himself as one of the greatest traders on Wall Street. He successfully predicted the 1987 Black Monday crash and tripled his money on that fateful day.
Yes, there will be some type of a decline, without a question, in the next 10 to 20 months, and it will be earth-shaking, it will be saber-rattling, and it'll have Wall Street in a tizzy, and it will create headlines that will be that will dwarf anything that's happened at this point in time.
Paul Tudor Jones II was born on September 28, 1954 in Memphis, Tennessee. His father, John Paul Jones, practiced transportation law from an office located next door to the Daily News, a publication his family has owned and operated since 1886. Jones graduated from Presbyterian Day School, an all-boys elementary school, before attending Memphis University School for high school. Jones then went on to the University of Virginia, where he was a welterweight boxing champion. To pay for tuition at the University of Virginia, Jones wrote for his family's paper under the pseudonym Paul Eagle.
Anyway, I played a whole bunch of games. Chess, backgammon when I was older. When I was in college, I was the bookie in our fraternity. So I had, by the time I graduated from college, I already had probably at least a master's in probabilistic theory.
In 1976, he earned a bachelor's degree in economics from the University of Virginia. After graduating, Jones asked his cousin William Dunavant Jr. for an introduction to trading. Dunavant was the CEO of Dunavant Enterprises, one of the world's largest cotton merchants. Dunavant sent Jones to talk with commodity broker Eli Tullis in New Orleans. Tullis hired Jones as a floor clerk and mentored him in trading cotton futures at the New York Cottons Exchange.
So I think it was February of my senior year. The guy that I inherited the book from said to me, oh man, and his name was Bob Wilson of Wilson, Arkansas. Robert Ely Wilson V of Wilson, Arkansas. He said, you got to try this soybean futures. I'm back and we're hedging up. They had a huge plantation at the time in Arkansas. We're hedging up our soybean crop, and this just makes football gambling just pale in comparison.
At 24 years old, Jones became a commodities broker for E.F. Hutton and Company. However, Jones was fired when he fell asleep at his desk after a night of partying in New Orleans.
I had no idea what I wanted to do other than drink beer, and that I was extraordinarily good at.
In 1980, Jones was accepted to Harvard Business School but did not attend because he deemed it too theoretical and impractical, believing that the only way to beat the market is to play the game of the market. Therefore, in 1980, Jones founded Tudor Investment Corp., an asset management firm headquartered in Stamford, Connecticut. At the time, Jones was still a relatively unknown money manager with only a measly $30,000 to trade.
But then after a while, I realized I could do so much better if I just traded for myself, because the commissions back then were $90 a contract. Can you imagine that?
Yeah.
And what is it now?
You could trade $40,000 for $90 today.
Yes, exactly. So it was $90 a contract, and I realized I could go trade for myself and clear. I think even then, clearing was still 30 or 40 cents a contract, and just do. And I started doing that for myself, and I did really.
So you were successful from the start?
Pretty much.
The Tudor Group, consisting of Tudor Investment Corporation and its affiliates, is involved in active trading, investing, and research in assets across fixed income, currencies, equities, and commodities asset classes and related derivative and other instruments in the global markets for an international clientele. The investment strategies of the Tudor Group include, among others, discretionary global macro, quantitative global macro, discretionary equity long or short, quantitative equity market neutral, and growth equity. In the 1970s, Ronald Reagan's policies lead to a market boom, but with it came high inflation. This led to a stagflating economy. The PE ratio for the S&P 500 was way above 20. In 1987, Peter Borish, second-in-command to Jones at Tudor Investment Corporation and Jones economist, anticipated the crash in the spring of 1988 by mapping the 1987 market against the market preceding the 1929 crash. However, on October 16, 1987, Jones noticed that the S&P had come down and knew once the sell-off began, there would be no going back. He shorted S&P 500 futures. In simple terms, a futures contract is a standardized legal contract to buy or sell something at a predetermined price for delivery at a specified time in the future between parties not yet known to each other. The contract itself has value. Jones also took longs in the bond market, anticipating lowering of rates by the Federal Reserve, since the Federal Reserve prints money during a recession to increase liquidity, helping the stock market to recover. With that in mind, knowing that the market would experience an overflow of liquidity from the Fed, Jones starts buying back the index cheaply while other traders are still devastated, further increasing his profits. This bet paid off since the bond market soared, and this combined with shorting index futures of the S&P 500 enabled him to return 200% on his portfolio, 125.9% after fees, earning $100 million.
Good evening. Today is Black Monday, the day the Dow dropped more than 500 points, the day the Dow dropped more than 22%, almost double the rate of the Black Monday that signaled the beginning of the crash of 1929. But this crash of 1987 is not just an American experience. Around the world, stock markets fell faster than a skydiver without a parachute.
By the mid-1980s, Jones, as reported by Institutional Investor magazine, was developing a reputation for courting models and partying long into the night. And the Wall Street Journal ran a front-page article referring to Jones as Quatrain Man in a profile covering his lifestyle.
Literally that weekend, I read a story on a guy named Richard Dennis, who was the biggest local at the Board of Trade, and then he used to say that he did his best trading when he was hungover because there was no emotion. I thought, this is starting to get close to what I'm culturally pretty good at.
In 1988, Jones married Australian-born Sonia Klein, a New York-based yoga entrepreneur and model, at a wedding in Memphis. In the 1960s and 70s, Japan saw unparalleled growth, becoming the second largest economy. In the 1980s, growth slowed down partly because Ronald Reagan limited imports from Japan into the U.S. Japan turns to printing money as an alternative, basing the stock market and the land market on a credit situation. In 1988, Jones noticed that the Japanese market started to go parabolic. He was, however, hesitant to go short since Japan had no index futures, yet Jones mostly made his bets on futures because the leverage allowed one to post smaller margins. When index futures were first introduced in Japan in September 1988, Jones even went to visit Japan. He watched trading live at one of the brokerage houses and noted that trading volumes had already eclipsed that of the U.S. market prior to the crash. Jones started being bearish when the Nikkei was at 24,000, but it kept rallying to 37,500. The market boom lasted longer than Jones predicted. Despite misdiagnosing the market, Jones managed to protect his capital through calculated risk-taking. From then, the market started showing weakness. Jones knew this situation was unsustainable, saying that the book value for the Nikkei was 5 times its worth. However, Jones patiently waited for the bears to come into full play before going short on the Nikkei. In 1990, as the Japanese equities bubble was bursting, Jones returned 87.4% through shorting the market. His bet paid off as the Nikkei lost 73% of its value.
The Bank of Japan had been trying to control excessive borrowing since May. Over the next 15 months, it raised the discount rate by 3.5 percentage points. By October 1990, the bears had cut the Nikkei's value in half. Property prices in central Tokyo fell by a third. Japan entered its lost decade.
In 1994, Tudor paid a fine of $800,000, the second highest at the time, to the U.S. Securities and Exchange Commission to settle allegations of violating the uptick rule, part of the Securities Exchange Act of 1934 that prohibits the sale of a borrowed stock while the stock is declining. Morgan Stanley and he sold Jones 2 customized put options, allowing him to sell the stocks to Morgan Stanley at a designated price. This violated the uptick rule, causing Jones a hefty fine of $800,000. Jones says he is very conservative and always has insurance against the worst-case scenario. Jones even claims to be the most conservative trader.
Where you want to be is always in control, never wishing, always trading, and always, first and foremost, protecting your ass. And that's why most people lose money as individual investors or as traders, because of the fact they're not focusing on losing money. They need to focus on the money that they have at risk. How much capital is at risk in any single investment they have? If everyone spent 90% of their time on that, rather than 90% of their time on pie in the sky ideas about how much money they're going to make, then they'd be incredibly successful investors.
He also takes asymmetric bets. His potential gain outweighs his risk 5 times. Tony Robbins describes how Jones has a 1-to-5 risk to reward ratio on his trades.
I was hired to come in. I uncovered for Paul Tudor what he was doing at his best. I got to interview all the people around him. I watched films. There were patterns that Paul Tudor was doing when he was at his very best, and he dropped them out. One of those things that I learned from him, he risks for asymmetrical returns. In other words, most investors think you take huge risks if you're going to be a billionaire, huge risks to be really successful financially. The truth of the matter is these great investors do not take those huge risks. The vast majority do not. Asymmetrical risk reward means they try to do the least amount of risk possible with the most upside. He would look for investments where he didn't want to invest unless he believed if he invested $1, he could ultimately make 5 off that dollar, 5 to 1. Now, he knows he's going to be wrong lots of times. And so he knows if I risk $1 and I lose, I can risk another $1, I'm still going to be up 3, you follow? He could be wrong 4 times out of 5 and break even still. So that's the secret.
Another one of his secrets to success is systems thinking, which involves making sense of the complexity of the financial world by looking at it in terms of wholes and relationships. For instance, he understands that when the Fed prints money, the bond market soars, or how gold prices have inverse correlation to the US dollar.
Like right now, I'm watching the currencies, I'm watching crude, I'm watching stocks and bonds. They're all interrelated. You know, the whole world is simply nothing but a big flow chart for capital. And if I start getting hurt in, for instance, stocks or bonds, then I'm going to make a total portfolio adjustment just because of the fact I might not like the way the numbers are going over the course of the day.
Back then they handed you, at least in the commodity division, E.F. Hutton, this gave me a book on technical analysis of stock trends by McGee and Edwards. He told me, read that. I read it. Go home, read it again. I read it. Go home, read it again. I read it. He goes, you're ready to trade. You're ready to open accounts.
Jones had only one losing year, 2008. He was a long-term holder at Lehman Brothers with $100 million worth of stocks. When the stock went to zero, Jones lost all $100 million.
Lehman Brothers is going bankrupt, and financial markets from Asia to Europe are doing their utmost to prevent Monday from turning from dark to black. Employees of America's 4th largest investment bank saw the writing on the wall late Sunday after talks to pull them back from the abyss collapsed. British firm Barclays Bank said no thanks, while Bank of America decided instead to help another struggling bank, Merrill Lynch, in a merger deal worth over $50 billion. The U.S. government said it won't bail out Lehman, which last week announced more than $3.9 billion in losses. Shares in Lehman Brothers have plummeted more than 80% in 2008 alone.
He was also unable to liquidate his long bond positions because of the bond market sell-off. He only lost 4.3% because he had shorted index futures which counterpoised some of his losses. As from 2014, Jones' returns have dimmed because he took a more conservative approach to the market, making his returns less wild. Over his career, his fees were set at 4% per annum of assets under management and 23% of the profits over the standard 2% per annum of assets under management and 20% of the profits because of his wild returns. Jones is also a philanthropist. Jones is the founder of the Robin Hood Foundation, a charitable organization backed mainly by hedge fund operators that attempts to alleviate problems caused by poverty in New York City. The organization also administers a relief fund for disasters in the New York City area. Paul Tudor Jones is easily one of the best traders ever. His unconventional trading strategy coupled with clever risk-taking have enabled him to leave a legacy in the financial world and gain a net worth of $8.1 billion as of today. His fund now manages $44.5 billion.